Hello, this is the video for valuation. If you'd like to walk along with this video, you can do so by downloading the Excel file. You'll also find that the solutions is in the next tab over, so if you'd like to have this for future reference, that is there. In this, we'll be looking at how to calculate discounted cash flows, as well as pretty much NPV for these problems, as well as using market multiples to find a value. So for problem number 1, so calculate NPV given the following assumptions. So we have a required return of 6%, a total life of the project being 8 years, and the cost of the project being $10,000. So at the end of the project, we can see that the project has a salvage value of $500. So we are given this table of information. Given that table of information, we can see that this salvage value needs to be added to the last year because that cash flow comes at the last year, which is year 8. So we can go ahead and add that $500 real fast before we start the problem. So that took that 2,300 to 2,800. So to start the NPV function on Excel, you simply type in NPV and it comes up. So our rate is 6%, and we have a given value. So Excel doesn't understand times 0 or the cost of the product or this whatever the project is. So we're going to have to go ahead and just take the present value or the PV or the present value of the cash flows, the irregular cash flows, and go ahead and finish that off. And then we're going to have to add in our remaining $10,000. So the present value of the benefits minus the present value of the costs. And that will give us a negative NPV, which means our costs of the project do not meet all the cash flows that are going to come from the project after 8 years. So therefore, it doesn't make us very much sense to actually invest in this project. So question number 2, calculate NPV given the following assumptions. So this is a very similar problem, just given different cash flows. So we're given the required return of 6% or life of 8%, and the cost of the project is $10,000. So the cash flows for this project we're at a constant of 1,700 for all the years. So we do not have a salvage value in this one, so we don't add that. So we can see that all the cash flows are identical and our cost is the same. So we can go ahead and start the NPV. We know that our required return is 6%, and we can go ahead and put the cash flows. So again, we can't put in times 0 the cost or the cost of the product because Excel doesn't understand that. So we have to add it at the end. So by doing so, we come up with a positive NPV, meaning our cash flows or our benefits are greater than the cost of the project. So we should probably take on this project. Number 3, so Computer Inc. is interested in buying out a company similar to theirs called PCs for Everyone that operates in the same state. Computer Inc. has the financials about the company as well as information on a company similar to both companies sold recently for $1.5 million. So given the following information, what would you expect to offer? So we need to come up with a multiple. So we're going to come up with an revenue multiple. So we need to it's going to be our value of the firm at a date given our revenue figure that we're given. So we're going to do the 1.5 million and divide it by our 150. So we come up with an EBIT multiple of 10, which makes sense. All right, so to come up with the value for this firm that we're going to take on, we got to multiply their revenue by the EBIT multiple, and we come up with 153,000. So this is how much we are going to be willing to pay. So number 4, Trevor Coe would like to acquire a company that they've been interested in for years. Just recently heard about them going available for sale. The list price is $3 million, and Trevor Coe would like to know if this is reasonable. Trevor Coe has found that similar companies have sold with an EBIT of $100,000 and a sell price of $1 million. So what is the multiple for the company? If EBIT for the acquired company is 2.5, or 2,500,000, what is their value given their multiple? So what is their multiple? We would go ahead and figure out that we need to take the value of the firm, so the 1 million, so our value divided by our base, which is EBIT, which is 100,000. And then, like we did with the last problem, we got to go ahead and times this. Oh, we forgot to. So we come up with 10 again. So if we take this 10 times ratio, this 10 times multiple, and times it by the EBIT of the company that we plan to take on, we come up with 2.5 million. So number 5, given the information calculated above, is the price asked reasonable or not? So they have a list price for this company of 3 million. We calculated that it should be worth 2.5 million. So therefore, no, it is not reasonable.
My name is Rick Haskell, and I'd like to thank you for watching this video as part of the Bill and Vieve Gore School of Business's Business Certificate Series. I'm a finance professor in the business school, where I'm also the director for the college's Center for Financial Wellness. The Business Certificate Series is offered through the Center as part of our outreach through the Gore School of Business. You can follow us on social media through Westminster's Instagram, YouTube, LinkedIn, or Facebook pages. You can use the QR codes provided or simply go to these websites. Thank you.